Time now to take a look at the markets. Trading was subdued in Europe following losses on Wall Street on Thursday and Asia on Friday. Investors punishing companies that will be hurt by artificial intelligence, it seems. Well, to make sense of this all, we can turn to Jameel Ahmad, Chief Analyst at GTC. Good to have you with us again, Jameel. What more can you tell me about investors dumping companies that could likely be disrupted by AI?
Thank you, Huxley. Actually, towards the end of the week, we've just suffered from a little bit of profit taking across a few different assets, not just those particular stock companies, but also across gold. We've had a bit more volatility in silver and also in cryptocurrencies. So I think that maybe investors are just looking to readjust their position somewhat. There has been a view that certain companies might actually see job losses based on AI and artificial intelligence and so forth. But generally speaking, if you look what happened with technology firms over the past couple of, decades, you're actually seeing the profitability goes up when there's, less costs on employment and hiring. So in theory, that should actually improve the profitability and improve investor sentiment. I think as well, we're looking for a little bit of a catalyst now to support financial markets. We have some economic data for the United States this week that do not really suggest that the US Federal Reserve, the US Central Bank, will be in a hurry to cut interest rates. Historically, that's been very good for stock markets. So I think investors have taken some profit there. But again, we're seeing that on different asset classes. So I wouldn't look at this as just an AI story independently.
And Jameel, looking ahead, traders looking at a lot of US economic data coming in today.
We've had key economic data throughout this week, starting with US retail sales, but we've also had the delayed US non-farm payroll report. That's the employment report monthly for the United States. It actually showed that the US economy added close to double what was expected in terms of jobs last month. And later today, we're expecting the US inflation data. Both of these reports are also key because it does provide a timeline for when the US Central Bank might start to cut interest rates once again. But looking at the non-farm payroll report, the initial reaction was that actually financial markets were quite impressed that the US economy did add more jobs than what was expected. It showed potentially some resilience in the US jobs market. And actually, they started to cut expectations back for US interest rates until July. So we're not expecting an interest rate cut now until July as we speak. However, if that inflation report that's due out on Wall Street in a couple of hours suggests that inflation is cooling faster than expected in the United States, do not be surprised if the US administration, particularly President Trump himself, starts shouting at the Fed, the US Central Bank start cutting interest rates, and then markets might get a little bit more nervous.
Meanwhile, we're covering it extensively here on France 24 today. The Munich Security Conference is going to be followed closely by markets, presumably.
It will be, not just because of near-term financial market implications, but because of what it might mean for the European economy, the Eurozone as a whole over the next couple of years. Generally speaking, the initial takes is that we're seeing some togetherness, again, from European leaders, suggesting that there is unity. But we're also looking at a uniform approach that each European economy and many leaders are agreeing to spend more on defense spending. That means more government budgets being spent on the economies. That's good for the Eurozone GDP, and it will help sectors such as technology, advanced manufacturing, and those types of industries. So that might help the stock markets and those sectors over the upcoming period.
Jameel Ahmad, thank you very much.